Hey guys, welcome back to Financial Markets. So today I've got a really good video for all of you. I've got Steve Burns here with me, and arguably one of the most famous traders in the retail community space that we all sort of look up to, and I'm sure we're all avid followers of his tweets. And so you see, he's obviously been a successful trader. He's written books, and so let's sort of begin with the interview. So welcome, Steve.
Oh, thanks for having me today.
So let's start at the very beginning. So about how you got into the financial markets field, and were you very successful from the start, or how did your journey sort of evolve from this beginning?
Yeah, it really started all the way back when I was a teenager. I was one of the few teenagers. I was 16 or 17 looking at compound growth tables of capital and knew the potential there if I could get enough capital and then compound it, that how much it could grow to at a young age. I think something Warren Buffett was also very interested in, the math of how it works. And so I looked at that, and the best place I saw to do that was the stock market. So as soon as I was old enough to start having some capital, I started in the stock market around 1992, 1993. I started just putting as much as I could aside. And, my first thing was tech stocks. And I bought and held a bunch of tech stocks in the 90s and did very, very well. So really, I got lucky and started out doing the right thing at the right time, being aggressively long tech stocks during the 90s. So beginner's luck, but then I was educated on the dangers of holding for too long and letting profits disappear. And so I did have enough to pay my if I chose to, I had enough to pay my first starter home off when I was 27 years old in March of 2000. But I did not, and I had a 50% drawdown from my capital peak in March of 2000. So then I learned how to really trade after that, and went into some deep studies, read about 400 trading books over the years, and started a much better active trading in 2003. Knowing more of what I was doing, trading trends, and then exiting with my first big windfall in January 2008, and avoiding the meltdown that time, and then developing some trend following and swing trading systems, 2009 on, and doing really well.
So you were saying obviously that you were interested. So were you always interested in maths though? Was that something that was the initial driver, that because you enjoyed numbers, you sort of looked towards the stock market, or was it more about, as a young person that you were looking at that point, just finding ways in which you could generate wealth, and you saw that the compounded market, the returns you could make in the market was the best option for you at that point?
Yeah, the love of math. I loved entrepreneurship. I love business. I love business management. I loved, shopping malls in the 80s. I thought it was fascinating. So yeah, math was my true love. And then I saw that being able to own a publicly traded company in the stock market was the best way to grow money and compound it through companies that went up in value through their earnings. So yes, the core of everything I've done to this day is math, even in the trading and the risk-reward ratios and the moving averages. It's in the systems. It's all math. Yes, but I also love anything with math and entrepreneurship and business too.
Right. And so when you initially, put on your first couple of trades, or during the tech period that you said you started investing, were you looking at that point to make a quick buck and get out the position, or were at that point you were looking to hold those companies, like you said, Warren Buffett was holding companies for 5-10 years? Were you looking to hold companies for a long duration, or at that point was it just sort of make a quick buck and get in and out and keep playing?
There was long-term time frames, buying in really baskets of tech stocks. I really focused on mutual funds, tech mutual funds early on, and it was long-term positions, buying companies inside of those mutual funds and letting it run as a diversified, just betting on tech. Really, my bet was on tech and the growth of technology through the 90s for long-term gains. It wasn't quite buy and hold, but it was more definitely long-term trend following.
Right. And did you couch at that point, coming across the aspect of feeling like greedy and wanting to, maybe cash out on your positions because you saw, you were on paper making profits? Did you ever come across those sort of emotions and feeling when you first started that maybe I should just take some money off the table because I've made a good chunk of profit, say on this X position and so on?
No, I did not have. One of my strengths has always been letting winners run. I have no problem if something's working, something's winning, and I'm up, 20% one year or up big in the stock. I've never had a weakness of letting profits run And that's been one of my biggest strengths. It can be a weakness in choppy markets or during bear markets, which I learned in after 2001, 2002. I learned that was no longer a strength, that the NASDAQ could go from 5,000 back to 2,000 and even under 2,000. So no, I've never had trouble. But I mean, later on, I did have to make myself, after experiencing the meltdown, I did have to work to let winners run after that. I still did it, but it was not as easy having that fear in the back of my head.
Right. So in that case, then would you definitely agree with the point then that when people say that the market isn't a way for you to exchange it for your day job or your salary, then, because obviously, like you said, if you're holding the positions, obviously you're only at that point making those paper profits. So would you say then that could become for people a way of paying their bills, the market, or should they stay in their professions first?
Yeah, I think they should definitely keep a job for a long period of time if that's their path. I mean, you have to trade for a living is a completely different ballgame than trading for capital gains. And most people in the markets make their living off of managing money. Even some of the legendary traders, they manage money. They don't trade to pay their light bill based on their returns in the short term. So you need a large amount of capital, multiple six figures minimum, and very low monthly bills to even give it a go at trading for a living, because you have to understand the stress and pressure on you have to make the money. I mean, you also need at least a year worth of living expenses set aside as well to be able to pull it off. I mean, you have to have it's just like any other franchise business or any other serious business you go into, you have to be properly capitalized. So it starts with proper capitalization and not underestimating the pressure and stress of having to make consistent money to pay the light bills. Most people are trading for capital gains, not trying to make monthly payments. I mean, you should never have that close of a gap anyway. You should have a huge safety net between you and your capital and your bills. So the vast majority of people should definitely trade for capital gains.
Right. And so like you said, you initially started obviously with the tech names. And did you always stay within equities? Did you want to then move towards Forex or options, bonds? Where was your sort of transition, or were you always keen on staying within equities as asset class?
Yeah, it's stock market. The stock market's what I've studied. I understand leading stocks. I understand indexes. I back tested their price action patterns. I've done some options. Options are a little more different because they're all or nothing bets, and they can play out very quickly. They don't give you the time in most cases, and you have to overcome time decay. But I did trade options extensively for several years. But the stock market itself, I've now drifted more into indexes and sector and leverage indexes, leverage sectors, and some leading growth stocks. So I've been very focused. But the stock market is definitely what I've done all my studies in that I completely understand.
Right. And so what would your advice be to, say, some retail investors that are looking to first get started out in the field of, trading, investing? What should they first tackle? Should they first understand the market? And before they even put on trades, do you think they should understand the mental side of trading and the risk side as well before they initially begin? Or what's the process, you think, for retail investors to first begin?
I think this is something a lot of people aren't going to say in the trading world, but first of all, it's personal finances. They need to have a lot of people trying to get into trading. They should be following Dave Ramsey and getting out of debt. I mean, you can pay more off on your credit cards if you still have them than you're going to make trading in most cases. So first of all, getting the personal finances in order where you're out of debt and you're in a good place, then getting the capital up to make it a meaningful trading capital. And for the vast majority of people, if they have a 401k and they're working a job and they have a match at their employer, the first thing they should do is get that full match where they put in 5% of their income and the employer matches 5% or whatever their benefit is. That's 100% return off the top. That's much better than they're going to get in most trading circles. So, personal finances, getting a 401k match if they can. And then if they have to start out with a small amount of capital, just dollar cost average into an S&P 500 index fund. Maybe start with some trend trading of indexes starting out, but it's a very slow process. They don't want to jump from not knowing anything to trying to day trade Forex out of the gate. That's a good formula to lose a lot of money fast.
And what do you think is the fascination around sort of the retail investor when they first begin, that they want to go into Forex trading? Why do you think everyone wants to first initially start with Forex rather than understand fundamentals and go maybe into equities first?
I don't. It's too many people have the delusions of the get rich quick, and there's too many Forex traders push, and also the brokers in Forex just push so hard and try to show people things that are not realistic really early on, and try to hook them into things, and they get these think they get these illusions in their head from that specific market for whatever reason. That's just not realistic, especially if they're so undercapitalized.
Yeah, I was speaking to actually obviously I get some questions asked on my page, and one of them was a person that said, well, because we get so much leverage on FX pairs that we don't get that much exposure that we could get on equities, and so for them that's a way for them to get rich quick, I suppose.
Yeah, that is part of it too. You're right. So there's 100 to 1 or even as crazy numbers of leverage, which they don't understand. Leverage cuts both ways. So when you're on the wrong side of that, you can give back all your gains in one trade.
Yeah, definitely. And you obviously mentioning about personal finances being the main forefront of the ways that they should begin with. What sort of capital do you think is a good enough level for people to start and maybe drip feed into the market?
Well, for trading equities, you need 25,000 plus just to get through the pattern day trading rule. You can't trade. I think it's more than 3 day trades a week without being locked up against it, unless you have multiple brokers. So for me, it's always been 25,000 plus just to get in. So you can, and you might get stopped out, even though it's a day trading rule. Depending on your system, even if you're swing or trend trading, you could be stopped out of a trade in a day and mess you up. So I think minimum bear is 25,000 to have any seriousness about it. Now, investing or trend following, and you want to start dollar cost averaging, you can start. I started with zero in 1992, and just started putting money in as I could and compounding it over years. And it's amazing what you can do over the long term, but over the short term, you can go to zero very quickly when you're not prepared and capitalized and have a system, know what you're even doing.
And what would you say to individuals that they say that when they have even saved the capital, that they go and first experiment with demo trading? Do you think demo trading can give people an idea of how good of a trader they will be when they start investing in the real market? Should they even bother with demo trading to begin with, or what's your thoughts on that?
The problem with demo trading, which I think it's good to learn the mechanics of trading just to get a feel for it. I think it's good for that, but it has no emotions involved. And emotions can be, 99% of the action. Once you start putting real money at risk, people are blown away at the emotions that rise up, the fear and the greed and the wanting to take profits quickly and the ego not wanting to be wrong. Yeah, demo trading does not show your emotions whatsoever. So it's like playing backyard football versus playing NFL football with the intensity of the real trading, putting real money at risk, especially with different sizes. But I do think demo trading is good for the mechanics of trading. And I also think back testing is crucial. When you back test to see how systems would have performed in the past, you don't get the emotions of the drawdown or the trying to let the winner run, but you do see how the price action played out. So I think it's good for mechanics, but not showing you any part of the big part of trading, which is the emotions.
Right. And so moving on a bit so we talked a bit about the emotional side and how they should begin, but what about the sort of risk management side? So how should a retail investor, when they first start trading, how should they manage their risk? What is risk management to them?
Well, most of them can't do it because their accounts aren't big enough. I mean, basic real risk management is for trading, for active trading. It's different for investing, but for active trading, 10% position sizing. If you're trading with $100,000, you trade $10,000 at a time in a position, and stop losses on that 10,000 would be 10%. So if you're wrong, it goes against you 10%. You'd be down $1,000 in a 10,000 position size. That's the basics of risk management. That'll keep you safe and in the game. If you do not have those risk management processes in place, you will eventually blow up. At the minimum, you will at least have a 50% drawdown pretty quickly. And they'll also be shocked that a lot of the best traders in the world had 50% drawdowns. Bill Dunn, a trend following trader who's multiplied his accounts by thousands of percent over his career, also had 50% drawdowns. Warren Buffett, they talk about he's an long-term buy and hold investor for the most part, and even he had 50% drawdowns on multiple occasions. So, I mean, that is a thing of minimizing your drawdown into a drawdown, not a blow up. Because if you do not have risk management, that will lead to your ruin. You will eventually blow up with a string of trades. Once you get down 50%, you have to go up 100% and double your money to get back to even. So the math works against you. If you're down 20%, you have to have a 25% return to get back to even. So it's absolutely crucial to have each fractional betting sides, and if you're wrong, you lose about 1% of your capital on a trade, and if you're right, you can make 2 or 3% of your capital. So the risk-reward ratio, the risk side should be no more than losing 1% of your capital, and the reward side should be open-ended.
Yeah, for sure. And how long do you think, or if if someone asks you a question that I've done all the reading, I've saved my personal finances, I'm ready to invest in the market. How long do you think it will take me to become profitable in the markets?